Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Champion Real Estate Investment Trust Annual Report. And Champion Real Estate Investment Trust is a trust that focuses on investing in high-quality income-producing office and retail properties. The trust's portfolio includes prime commercial properties with a total floor area of nearly 3 million square feet. Some notable properties include 3 Garden Road and Langham Place in Hong Kong, as well as a joint venture stake in 66 Shoe Lane in central London. The trust offers investors direct exposure to these high-end properties, providing a stable source of income through rental yields. With its focus on Grade A commercial properties in prime locations, Champion Real Estate Investment Trust is an attractive option for those seeking reliable returns from real estate investments. Some key businesses and services provided by the trust include direct investment in income-producing office and retail properties, joint venture stake in select high-end properties, rental yields through leasing of prime commercial spaces. Overall, Champion Real Estate Investment Trust provides a unique opportunity for investors to tap into the lucrative market of high-end commercial real estate. Champion Real Estate Investment Trust maintains a market capitalization of $14 billion, broadly in line with the industry peer group. Champion Real Estate Investment Trust trades at a lower price-to-book ratio of 0.35 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 29% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The company have a dividend yield of 5.73%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted. On the growth side, several factors contribute to increased revenue. Higher rental commissions at 3 Garden Road due to increased leasing transactions are a significant driver. Additionally, interest savings from lower average HIBOR rates have reduced cash finance costs. Online sales have seen a 12.8% increase, while double-digit sales growth in the lifestyle segment has been achieved through proactive tenant mix management. The expansion of luxury and mainland Chinese brands has also boosted revenue. Furthermore, increased occupation of retail spaces by finance and banking firms, as well as cross-border and online shopping, have contributed to growth. Leasing transactions with Great Eagle-connected persons have seen a significant increase, while building management fee income from subsidiaries has also risen. On the decline side, several factors contribute to decreased revenue. Lower rental income due to abundant office supply and negative rental reversion is a major driver of decline. Decreases in net property income and distributable income have also been observed. Negative rental reversion on rental income and distribution is expected to persist, while softening tenant sales have led to a decline in Langham Place mall sales. The rise of online shopping has posed challenges for physical retail stores, leading to shifts in consumer behavior. Decreases in fair value have also contributed to revenue decline. Overall, the drivers of revenue growth and decline are complex and influenced by various market trends and factors. The company's financial performance is a testament to its ability to generate significant operating cash flows. According to the provided data, the net cash from operating activities for 2025 was HK $711,557, indicating a substantial increase from the previous year's figure of HK $172,400 in 2024. Furthermore, the cash generated from operations also shows a notable difference between the 2 years, with $1,456,310 in 2025 compared to $1,717,798 in 2024. However, despite these fluctuations, it is clear that the company has consistently demonstrated its capacity to generate positive operating cash flows. This is evident from both the net cash from operating activities and the cash generated from operations figures for both years. The data suggests that the company's financial management practices are effective in ensuring a steady stream of operating cash inflows, which is essential for sustaining business growth and stability. And the performance of various segments within the company's operations has been mixed. On a positive note, the 3 Garden Road and Langham Road office tower segments have shown strong results. The former generated segment revenue of $1,159,917 with net property income of $867,101, while the latter achieved segment revenue of $1,279,296 with net property income of $993,092. However, not all segments have performed equally well. Langham Place Mall has struggled, with a notable decrease in fair value of investment properties amounting to $841,906. This decline is a significant concern and warrants further investigation into the underlying causes. Overall, while some segments have excelled, others require attention to improve their performance. Management's outlook on the company's strategy is centered around adaptability and sustainability. The company plans to implement flexible strategies to optimize property performance in a challenging market environment, page 7. This approach will enable Champion REIT to achieve business growth while forging partnerships that advance a sustainable future, page 10. The company aims to operate within stated investment policies and regulations, ensuring a structured approach to its operations. Additionally, it will focus on strategic development and capital-raising activities from the market, pages 15 and 21. This proactive stance is expected to drive business growth. In terms of environmental sustainability, Champion REIT has set an ambitious target to reach net zero carbon emissions by 2045, page 28. Furthermore, management notes that the retail market showed signs of recovery in the second half of 2025, with prime assets expected to remain resilient and non-prime retail under pressure, page 70. This mixed outlook suggests a cautious optimism for the company's future prospects. There are concerns about potential disruptions in the Kowloon leasing market. Global uncertainties surrounding trade and sourcing pose challenges for tenants involved in supply chain operations. This could impact businesses tied to logistics and transportation, potentially leading to supply chain disruptions. However, these concerns stem from external factors rather than internal inventory buildup or supply chain issues within the companies themselves. That concludes the financial summary for Champion Real Estate Investment Trust. Feel free to comment below, and I will be happy to answer them when possible.